warm welcome to everyone who has joined us today. My name is PIYUSH and I am Professor in Property at the Faculty of Architecture, Building and Planning. Before we begin, I would like to acknowledge the traditional owners of land that I am on today, the Wurundjeri people, as well as the traditional owners of land you are situated on, and acknowledge that Indigenous Australians have been custodians of lands and waterways of Australia for thousands of years. I pay my respect to elders past, present, and emerging. As part of State of Industry webinar series, we'll discuss today the future of retail property post-COVID 2019. Few housekeeping things. Please post your questions through Q&A function on your webinar screens. My colleague Simon Alclep will monitor questions and pass them on to the panel. We'll try and take as many questions as possible as we go through the discussion. If there are still some questions that remain unanswered, we'll take them towards the end, if time permits. This week has shown a glimmer of hope that there is a light at the end of tunnel, and hopefully the lockdown that halted the economy and our lives since March will soon end. On the positive side, the daily and cumulative numbers of reported COVID-19 cases have declined, and the curve is flattening, though it is still stubborn at the lower end, and the uncertainties remain. Though the economy has seen 2 quarters of negative growth, the overall forecast for 2020-21 real GDP growth is minus 1.5%, negative, but better than June forecast, and much better than what the world is expecting, a contraction of minus 4.5%. Unemployment is still a concern, and it will take few years before we return back to 5% unemployment rate. Against this backdrop, the budget that was presented on Tuesday was a business-led recovery budget with enormous fiscal stimulus. Though the economic success of these measures depend on the containment of virus with easing of lockdown, given that there is a pent-up demand, manufacturing will recover, capital expenditure will recover. The question, however, is, what is the future of high contact services such as retail and hospitality? How consumer behaviors will change, some of which we observed during the last 6 months, is the question facing many industries. Would some of the activities revert back to old practices? How visible are current business model for sectors like retail, restaurant, and hospitality? Within this context, we have a very high-profile panel today to discuss the outlook for retail property. Let me introduce Peter HUDDLE. Peter HUDDLE is Chief Operating Officer of Vicinity Centers and has more than 20 years of experience in real estate development and asset management. He is responsible for leading the business and shopping center management, operation, leasing and marketing, and has extensive experience in multiple global markets, such as the US and Brazil, besides Australia. Welcome, Peter. Our next panelist is Richard Bowman. Richard is Oceania Transaction Leader at EY for real estate. He leads the real estate due diligence, transaction, and valuations on commercial, retail, tourism, development, and industrial assets. Welcome, Richard. We are also joined by Stuart Fox. Stuart is Managing Director, Victoria, and National Head, Valuation and Advisory at Savills, Australia and New Zealand. As a certified practicing valuer since 1998, Stuart provides valuation and advisory services to both domestic and international clients on investment-grade properties. His main focus is on retail asset. Welcome, Stuart.
Thank you.
Without further ado, let me ask Richard. Richard, when we talk about retail, it's an all-encompassing word, but underneath there are various segments which cater to different consumer needs. Could you tell us a bit more on how retail industry classifications are done and how the economy or the economic outlook that we are observing currently are going to affect these different segments of industry?
Yeah, thanks, Push, and good afternoon, everybody. I think it's a really good spot to start, actually, with just a bit of a discussion about, what is retail and how it serves different parts of the market, and the economy generally. Because understanding the different parts of it will allow us to sort of understand a little bit deeper about how it's being impacted. So when we think about retail, a lot of people jump to think about Chadstone, and it's an outstanding property, and Peter's probably smiling, as he's got one of the flagship stores, in the country there. But that's at one end, and at the other end we go right through to freestanding shops, and you think of Glenferrie Road or Puckle Street, Moonee Ponds, and then we've got a whole lot in between that. So we've got factory outlets, you think about South Wharf, we've got big box retailers that serve, different types of purchases, think about the Harvey Normans and those types of things. And then we move through CBD retail, being differentially impacted. We've got neighbourhood retail, we've got sub-regional centres, regional centres, So there's a big spectrum of retail property here, all serving different and distinct parts of the market, and actually all operating quite differently through COVID and through the structural change that retail is going through right now. So I think it's if we think about retail, we've got to think about what sort of retail we're really talking about.
Thank you, Richard. That's a good framing for the discussion today. And we have seen that different segments of retail have been impacted differently during this economic crisis that we have witnessed over the last 6 months. So could you tell us a bit more on what has been the impact of current economic state on different types of retail, the ones which you described just now?
Yeah. So there's been some really big winners and there's been some big losers. And the variation has been geographic. You think about Melbourne in particular. I mean, we all know, the lockdowns which we're going through and how that has resulted in, quite significant falling sales. And that's, mainly through store closures and through restrictions and what have you. But that's not universal. It's actually, there is some, improving sales performance, in Queensland, and, in some ways in Western Australia, it's like it never happened. So, they're going along reasonably well, from COVID. And then you look at, what's happening in terms of the different retailers themselves. So I think you touched on it in your opening remarks, Push. You talk about, entertainment and hospitality, hotels, those types of retail properties. Well, they're being massively impacted. Some of them are being able to stay open and, do click and collect. But then when you move through to the supermarkets, the Coles, the Woolworths, the IGA, they've had an enormous, increase in sales performance. As we saw this sort of early, COVID impact of people rushing and, buying and those types of things. Now they've normalised, but, Woolworths in their third quarter results, their food sales on a like-for-like basis are up 11.3% over the 12-month period. So that sort of demonstrates, really how, not only are we dealing with different asset classes, but we're dealing with different retail businesses, and COVID is certainly, impacting it, in a myriad of ways.
Yeah. Thank you, Richard. When we look at retail, it has changed over the last decade quite substantially. And let me ask Peter this question. Peter, the industry has opened door to experiential retail. Could you tell us a bit more about this catchword, experiential retail, and how do you think the industry has evolved over the last 10 years?
Thanks, Pash, and good afternoon, everyone. Looking in really simple terms, experiential retail is any sort of physical retail that's that does more than just sell product. So from our perspective, many of the services retail, particularly around food and beverage, around health and beauty, a lot of entertainment and leisure retail around cinemas, bowling, kids play, and then also a lot of new categories around wellness, whether it's medical, whether it's gymnasiums or micro fitness, that's all experiential retail. Essentially what experiential retail does is it tries to create a brand connection between a consumer and the retailer. Can be done through loyalty, can be done through social media, can be done through ambassadors. The luxury retail is a really classic example of how experiential retail connects consumers to a brand. So in the last 10 years, the industry, both here and particularly globally, has really moved to an experiential retail to try and grow the percentage of GLA connected to experiential retail. I see that as a trend that's going to continue, and it's really part of a structural change that's occurring in retail.
All right, thank you, Peter. Richard, the role of brick and mortar retail has transformed overnight by the COVID-19. The onset of physical distancing has swiftly changed consumer behavior, as we all know. Many people are buying online. The visits to physical stores have reduced. The days on which people shop are different than what they were pre-COVID-19. The distance that they travel has also changed. So how have these behavioral changes affected retail, and which of these would be permanent, and how they will impact the brick and mortar channels in the future?
Yeah, Push. Look, I think it's just worth calling out about the COVID change and putting it in context of what's been happening, in retail and the structural changes that are occurring, which were happening actually pre-COVID. And Peter's just sort of mentioned it as well, with the experiential, side of retailing. What COVID has done has really been to accelerate change. And look, I think there will be some things that will come out of this that will be a permanent fixture. Online sales, on a year-on-year basis, are up, around about 75%, depending upon sort of, who, which set of data you follow on that. But I think that the change that we're likely to see, permanently on the other side, at least for the next couple of years, will actually be around retail business formation. And we know that, in any one year, there are changes in the retail format. Businesses come into trend, they succeed, grow, and, sometimes fail. And there is turnover in those tenants of, anywhere around about, 10% per annum. But I think the challenge for bricks and mortar retail, post-COVID, will be how can the economy grow at a reasonable enough speed, enough size, such that people are willing to take the risks to start up businesses or to increase the number of stores that they've got, around the country, because they've got some really significant headwinds. There's a number that are looking at contracting, and, with business confidence low, the retailing world and bricks and mortar, it can suffer the churn. And that's not part of normal business conditions, but it's got to have the right conditions for people to be able to take the step and start and create new businesses and move in and lease shops and replace those that go. So I think that that will be the challenge for bricks and mortar. Post once we get through the health issues, is new formation of new retail businesses.
Thank you very much, Richard. There are two questions which are coming in. I will take them. Maybe the first one I'll request Peter to answer them. The question is saying that what do you think is the expected future of departmental stores? And do you expect decline in value between February 2020 and 22 for regional malls, neighborhood retail centers, CBD centers, and 4 to 5 star CBD hotels in Melbourne?
All right. So I might take the first question, sorry, the last question first, and I might bring Stuart into the conversation here. So he's the valuer. There's a couple of things at play. So, what I'm going to say is based on future events. So who really knows? So let's have a look at a couple of things. The first one is income and what's happening around income and income risk. And for those tenants that can get reopened and continue to trade, most of them will be able to continue to pay, rent at the same sort of level. There will be pockets that will push, you know, for reduction in rents, and some of them have been quite vocal in the papers. You know, we've seen that, but that's nothing. That goes back hundreds of years, tenants and landlords, you know, pushing each other around, you know, increasing and decreasing rents. But it's fair to say if the general economy slows, there will be, you know, a push on rents. Now, the other thing is that what influences values is cap rates and discount rates. So, you know, what multiple people want out of the assets. There'll be those who'll be a little bit gun shy around retail until they find out where it stabilises. But then on the counter, we've got these really, really low interest rates, low cost of capital, you know, and a lot of money that's shifting around the world. And, you know, yielding 5 or 6% on retail is actually going to look really good compared to yielding, you know, 0.5% or 1% on bonds, or, you know, interest rates of, you know, other, you know, low interest stuff that's going to be 2 or 3%. So the liquidity and the money and the demand side will actually probably do a fair bit to preserving, you know, values in the long term. You know, what we've got to probably do is, you know, get business conditions right so people are willing to take the step and open up, you know, open up businesses. Stuart, I don't know if you want to add anything to that.
Yeah, I can, Rich, and good afternoon all, and thanks for the opportunity to speak. Yeah, it's interesting what COVID has done to asset values. It's been far swifter than probably the last downturn that we had, which was back when we had the GFC. And I think when I think back to the GFC, it was sort of really, the start of that was December 2007, when the then Centro, which is emerged into what is now Vicinity through a few mergers, Peter, you know, was unable to refinance their existing loan commitments, and that sort of started a domino effect throughout the markets. And so we had a real liquidity issue that sort of drove asset values down then. And because it was liquidity, and values typically sort of follow transactional evidence, we weren't getting a lot of transactions. And so things sort of took a little while to sort of find their floor. And it really wasn't until, I think, December 2009, so really 2 years later, that, you know, really a ruler was put under the asset values of most of the major retail land, or all property owners of commercial and retail property at that point in time. This time around, it was far swifter. And, you know, it really started in March, when it sort of all dawned on everyone, we've got a bit of an issue here. And the reason it was a lot swifter was because we had a lot of cash flow issues impacting the assets. And when we look at the declines in value that have resulted in really the first quarters two, primarily quarter two and now quarter three of this year. The first was really all the COVID sort of short-term allowances that we were putting into valuations. And some of those were some short-term rental abatement allowances, which were an immediate hit to a below-the-line calculation on a value. It was also maybe longer periods to let up existing vacancies, a lower retention rate for tenants on expiry, and those sorts of allowances, which were all immediate impacts. I think the other impact was where I suppose there are two approaches to value that we adopt primarily in evaluation of retail assets. One of them is a capitalisation approach, a static approach of the current income or assessed market income. And the other was, I suppose, DCF. And DCF takes in a 10-year period that we consider the growth of income over that period of time. And the general sentiment is that we're not going to see a lot of growth in income over the next couple of years through retail assets as they stabilise to a new level. And with a lack of population growth driving expenditure, restrictions on travel, all of those sorts of things, that the view was, is a rent today going to be any greater in 12 months' time? Probably not. So in a lot of our valuations, you know, we've really pared back what our market rental growth forecasts were. And what that has done is sort of create a bit of a divergence between our two approaches to value. And it certainly provided a bit of a drag on our discounted cash flow calculations. And whilst they're two independent approaches to value, we do like there to be some marriage between the two. And so that sort of has led to some capitalisation rate sort of increases across the board. So that was the second one. The third one is really been about the view on income and where will income stabilise in a post-COVID world. And undoubtedly across the board, the expectations that we've seen from many retail landowners has been that their leasing expectations prior to COVID and post-COVID have certainly come back. And so all of those things combined have resulted in quite a swift and immediate sort of decline in values. Now, I'd have to say that probably sitting here at the moment, the bulk of that adjustment really happened in the second quarter of this year, that period between April through to the end of June. And really in the third quarter that we've kind of just finished, there probably wasn't as much a difference. I think from a value perspective, what the valuers are really seeking in the market is evidence. And there's two types of evidence that we're seeking. One is transactional evidence of asset sales. And we're starting to see a few of those, but more at the lower end, sort of 150 mil below, more so than the more dominant regional centres, where there doesn't seem to be really any transactions in play at the moment. But the other key bit that we're looking for as we go to December is really leasing transactions, because there hasn't been a great deal of that done in the last 2 quarters either. And so we're really looking for some confirmation about where are rental levels being struck at going forward. And that then has a flow on to what market rent assessments are and what our expectations are of rent come lease expiries coming up. So they're the things when we think about what are the influences that are going to happen over the course of the next 3 months, 12 months. First one, most immediate, will be where leasing activity starts to settle. And the second one will be, as transactions come back, at what level of pricing are they coming in at?
Thank you very much, Stuart. Let me bring Peter in this discussion at this stage, because there's a question from a participant, and participant is asking us to comment on there has been an increase in online retail spend as a percentage of total spend in the last 6 months. To what extent do you think that this will be a sustained long-term trend rather than a merely temporary blip?
Look, there will be an increase in spend online. I think COVID has accelerated that. But it depends on the classification of online. The majority of sales online within the Australian marketplace actually come from physical retailers. So that's the clear difference between Australia and the US, where Amazon is so strong and powerful. We're early into the US and have a dominant position here. They're late into Australia. They will be strong in Australia, but fundamentally the existing physical retailers already have great online platforms, and a lot of the distribution or fulfillment from that online actually comes from the store. So the key change is further increase in a percentage of spend online will occur. We saw that occur through COVID. And then when you look at Queensland, Western Australia, South Australia, in particular the states that have opened up and been very strong since opening, you see the online sales come back down and physical sales go back up as a percentage. So the key is really for retailers moving forward is to have an omni-channel business. For landlords, it's to make sure the centres are digitally connected and have the technology in their centres to enable fulfillment for the retail of sales, whether it's physical or digital. And for the retailers, there's some very, very good online multi-channeled retailers in Australia, but all of them, particularly in the product sell space, need to have good omni-channel offerings, technology offerings as well.
I think that's undoubtedly the ability to access your market. And as we all know, Australia's a pretty geographically spread country, and I think the key to this has been that it has been the fact that the physical stores have really been the fulfillment for these requirements. And I suppose the challenge that will come out of that will be as more growth comes from those online sales, tenants will actually look at what level of store requirement they need, and do they need just to keep rolling out stores, or should they become far more selective about where their store locations are? And that all bodes well for the more dominant, well-located regional centres that have a dominance over their catchment. And it probably bodes well for some of the smaller neighbourhood type centres that service their local community. I suppose it's that gap in the middle as to, will that diminish some of that tenant demand in some of those I suppose, sub-regional type centres, and then how do those spaces get repurposed?
Yeah, I think that's a great point. And probably I'll bring the question of value of retail again back into the discussion. You did mention that value would be impacted in some ways. Now, over the last 6 months, people have rediscovered their local stores and neighborhood shopping precincts to some extent. Do you think that these changes will be permanent and people will continue to patronize their neighborhood shops? And to what extent would they contribute to the value of small shopping precinct, which may grow and become more competitive?
Yeah, it's an interesting concept because, I mean, certainly the 5 kilometre restrictions certainly created a sense of community, hasn't it? I haven't walked the streets of Surrey Hills as much as I ever have in the last few months. And, you know, I suppose the frequency of shop, it's been one of the few joys of the day is to actually get out, to go to the supermarket and grab something and grab a takeaway coffee. It's about the only joys we've had over the last few months. And look, I think people probably have rediscovered, you know, the convenience of having a well-established shopping precinct. And you know, when you go around Melbourne's sort of prominent retail strips, they all go through evolutions. You know, we mentioned, and I think about this myself. You know, Swan Street used to, you know, I suppose be the downtrodden part of Richmond compared to Bridge Road, and now it's kind of the role reversal. Like Swan Street's a very vibrant sort of, you know, food offering that services that population. You see that probably in, you know, between Brunswick Street and Smith Street. I mean, Brunswick Street was always the more dominant one, but that's swapped over, and it's now Smith Street that provides again that offering that's relevant to its catchment and its demographic that's around there. So I think undoubtedly people have found that, and having a well-serviced local community strip is very important. Now, that's great for people that live within a 10-kilometre radius of the CBD, but yeah, and we've probably seen that when you go out, say, in some of the more growth areas. It was quite reassuring that I was out at sort of Werribee during the first lockdown, and you'd walk through the Pacific Werribee Centre, the more dominant, larger centre. It was a ghost town. And then I'd go a few kilometres up the road to the new Tarnate Central Shopping Centre, which really serves that local community service for that surrounding catchment. It was vibrant and busy, and that was very reassuring. So I think certainly the need to have a local offering that caters to the needs of that community, and they're different in every community, both, you know, ethnic wise as well as sort of socioeconomic wise and age wise. But then there's also the place then for the more dominant regional centres that provide that discretionary offering.
All right, okay. Maybe I will pose the same question to Peter as well, that given that there are behavioral changes, do you think that landlords of large retail malls are considering change of strategies or tactic in that sense?
Yeah, look, I agree with Stuart's comments, PIYUSH. The interesting one, I think the neighbourhood shopping centres will be the first to test the valuations, because that's where the first transactions will come through as well, particularly as Richard mentioned in a low bond yield environment, and we're already seeing the huge amount of interest and some transactions starting to come through in that space. The business that I'm involved in, we have the very large centres, we have DFOs, we have CBDs, and we also have the neighbourhoods. And I agree with Stuart, the ones that are caught in the middle, that are larger centres that don't necessarily dominate their trade areas, where the major challenges are. The neighbourhood shopping centres have typically always been strong. They do need to be relevant to their community. They do need ongoing investment. And I think COVID has accelerated the trend of shopping local. It has really there was some concern about, you know, the fresh food category, the local grocer and butcher and the poultry guy. They've actually come on very strong. And they're typically surrounded in those neighbourhood shopping centres with a supermarket on either end. Some of them have a discount department store. 30 or 40 stores that are basically service orientated is a strong product offering that we think will be even stronger coming through COVID with the right offer and the right investment.
Yeah, I think sometimes, and probably with the American experience, it'd be interesting to hear that, because I think about Australia, and Australia is very much a population-led story, but we do have a pretty rigid planning regime around where our centres are located. And even the secondary centres typically are pretty well located. It may just be that they have a more dominant centre in their catchment. That is meaning that it's putting a bit of a cap on what retail performance or retail sales that they can achieve. And I've thought about this a few times, is that those ones that are caught in the middle, from a retail perspective, are probably going to go through a period of struggle where, I think if I was at, say, Westfield Doncaster, if I get a vacancy, there's going to be a retail use to go back into that space. But if I'm down the road in a centre that's maybe more challenged, if I get a vacancy, I might not have that immediate retail use to go back in there. And you might end up with a period of heightened vacancy in some of these centres, and you might not have an immediate retail backfill. And so, but they are still very well located. They service a catchment. They have good road infrastructure. They largely sit on large land holdings. There are other uses for this space, and it might just take a period of time to, come to grips with what that repurpose opportunity is. Which I think if you go to America, that planning regime is probably not as rigid, Peter, is it?
It's not rigid at all. Every local council, essentially the councils control the planning regime, and everything's driven by a GST tax that funds the councils. Councils fund, so absolutely right. It's definitely a more strict approach here, which is reduce the GLA per capita of retail. But all that said, there has been some overdevelopment. So even though there's some centres that are well located, they don't have the market share that they need to be sustainable. And fundamentally, what we term as retail-led mixed use or changes to the use will come in, which I think is part of the evolution of the next phase of retail shopping centres in Australia.
Let me bring the discussion on the retail leases. And let me ask you, Peter, that question. That given that most of the leases in retail are short-term and there are uncertainty to cash flow for retailers, how has this changed the cost of managing short-term leases and tenant due diligence for big centers?
Yeah, no, it's a good question. So we have about 8% of our leases that are in, we term short-term leases anything under 18 months. About 8% of about 8,000 leases that are on short-term. That has increased through COVID with the amount of uncertainty, and particularly with things like the Commercial Code of Conduct in place, that essentially there is a significant increase due to uncertainty, due to retailers' cash flow and short-term leases. So from our point of view, what changes? There's an internal administration cost of changing. So people to actually negotiate those deals, to document those deals, to invoice those deals, on top of the short-term COVID assistance for those deals. And there is what hasn't changed at the moment, despite popular media by certain retailers, is the structure of those leases. So they're still fundamentally either a gross lease or what I call a triple net lease, where it's traditional base rent plus outgoings and promotions, rather than leases as a percentage of turnover determined. And so at this point in time, that structure of the lease hasn't changed. The returns have changed somewhat in the short term due to the uncertainty of the marketplace, and the administration to actually do those leases has increased. So we anticipate that's probably, from our perspective, this year has been a grind, no other word to express it but that. And to be honest, I think the first 2 quarters of next year will show the true effect. Once stimulus package comes off, Commercial Code of Conduct, there's been very little voluntary administration this year. So we think the back end of 21 is probably when a more normal environment occurs and more normal leasing environment occurs at that point in time as well.
Right. Thank you very much. Let me bring Richard in here. There are 2 questions from participants. The first question is, Richard, do you think there will be an impact on industrial land, given that there will be a greater need for distribution centers to support online sales?
Yeah, and that's already showing up, Push. It's being measured through valuation changes that are happening at 30 June. We've seen some of the industrial REITs, have an uptick. We're seeing the increased demand for packaging and processing and warehousing. So in a perverse way, as sort of, retail, goes into the headwinds, it's the industrial market that's going to have the tailwinds behind it. Now, I suppose the question is, will that continue? There's certainly a lot of people who are very much believing that that's the case. If you have a look at the retail REITs, the cap rates for industrial premises, there's a lot of people that are putting a lot of faith in industrial being the big winner out of COVID and the structural change that's happening. There's a big difference, however, between industrial and retail. And that is that, industrial is very easy to replicate. Okay. And, with a lot of flat land around Melbourne, maybe not the same case as if you go to Sydney, but, we can build industrial all the way basically from Melbourne to Adelaide because the land there is just very, very suitable. And the only short thing really is bringing servicing and zoning on. That's not the case with retail. And, so, everybody's jumping on board and, that's great. And there's always winners and losers. But, they will jump, those tenants will jump very quickly to the next warehouse that gives them that slight edge in terms of efficiency because they run a very slick supply chain, a lot of those industrial users. And so, buildings and locations often become very redundant and much more redundant than retail. So there's.
I think that's right, Rich. I think
both sides to that point.
If I add in there, Richard, I think the attraction about industrial has been obviously the long-term lease covenants that a lot of these newer facilities provide, and they're relatively set and forget, But what's not factored in, I suppose, to that is, well, what's the terminal value at the end of their 10 or 12-year lease? Whereas, and Peter would say this too, I mean, retail has become a very capital-intensive cash flow to maintain, particularly in recent years. But I always think that the difference between retail and, say, commercial, be it office or industrial, is retail is a goodwill income stream. I mean, the tenants only have value in their business if they have tenure and they have goodwill in that location. And I think that's a real key difference between the two asset classes. And yes, retail is going through its challenges at the moment, and there are many cyclical and structural changes going on. But ultimately, retailers, if they've got a good business, they're very invested in that location, and that drives them to sort of stay in that location, reinvest in that location. Whereas as a office occupant or industrial tenant, it doesn't really matter as long as I tick the boxes in terms of location and logistics and whatnot. That's about it, really.
I do agree with that. And maybe we can pose this question to Peter. This is a question also coming from the participants. Would there be new and emerging functions that retail space can provide in the future? And are there specific functions being explored for both smaller shops and larger centers? Peter? Yeah,
PIYUSH, look, I'll pick up that question, and a question I think we didn't answer before was on the department stores. So, clearly, I don't think there's going to be, in the larger retail space, I don't think there's going to be, in the short to medium term, significant expansion of retail area. It's going to be repurposing of existing boxes with higher productive uses. Easier said than done. And I think a significant component of that will be on the downsizing of both the two major department stores in Australia, who absolutely, I mean, it's a public knowledge they need to change their models. They need to have less space. They need to have less stores and have less space within their stores. They need to invest more in online. And in fact, this year, both department store operators have significantly increased their investment in online and sales. And they need to have a service offering in key locations, whether they be CBDs or the key regional shopping centres, but they don't need them all. So when you look at those big boxes and you say, okay, if some of those boxes come back, what are they going to be? They're not necessarily going to be retail. So they're going to be converted into things like co-working, commercial. They're going to be converted into entertainment and leisure, into health and wellness, into medical facilities. These are all the things that I know we as a company are focused on to ensure the vibrance. How we term it is we're trying to diversify and intensify retail. Retail will always be at our core. And we're trying to bring in non-competing complementary uses that really drive existing infrastructure. So not necessarily build new infrastructure, particularly on Monday, Tuesday, and Wednesdays of the week, where retailers traditionally, and even more so, a little bit slower, than the other end of the week. And then those uses sort of disappear over the weekend where retail has traditionally been strong.
Right. And do you think, Peter, these are structural changes, or these are just caused by COVID, or are they cyclical in nature?
Well, I agree with Stuart's comment. There's a combination of structural and cyclical changes that are going on in the industry. I think retail's not seen as a well, retail's essentially been beaten up by the markets and elsewhere at the moment, and I think it will find its natural cause, natural place, and I think it will rebound back. And fundamentally, I think a good example of that is what's happened with traffic and sales in the states that are not Victoria and don't have some implications of New South Wales and are not CBDs. And you look at how it's rebounded once it's reopened. For our space and also for the main strips, people are still after experiential retail, socialising together. And this is all about how do you change the offer to ensure that you remain relevant to the community. So I think that's the cyclical component of it. The structural component is more of a percentage going online. And there is also some behavioural trend changes in retail, people becoming less consumeristic, more sustainable, those type of things that I think are fundamentally more structural.
Stuart, I think when we look at these changes, there's a lot of uncertainty and volatility around property valuations at this moment. You touched upon this earlier. May I ask you, what are the key considerations that you would take to value retail assets today?
At the moment, it's really all about the sustainability of income. That's the primary consideration. I mean, when we look at sort of the investment parameters that are driving investment decisions across all the asset classes at the moment, none of that's telling us that things are really blowing out in terms of return expectations. And Richard touched on industrial before. I mean, industrial has really transacted through COVID like nothing's changed. If anything, the return expectations are firmed during COVID as more people have rushed towards that. So from a retail perspective, we don't feel that there's tremendous pressure on the investment metrics that you would apply to your income. It's more the income that you're adopting. And so that then brings in a whole raft of other considerations around your weighted average lease expiry and security of tenure that you have, the sales or turnover productivity that the centre is achieving, and then when we talk about occupancy costs, what does the retailer's cost of occupation, what is that as a percentage of their overall sales productivity, and is that sustainable and whatnot. So, and that then is one of the indicators of well, what is its penetration into its catchment area, and what are the things that are inhibiting that, and then you start to think about, well, what other opportunities exist for the centre. I mean, I must say in Melbourne, to put it in context, we're very fortunate that we have our larger retail centres are large land holdings. I mean, you go out to Chadstone, Peter, it's a 30 hectare site. You go out to High Point, it's a 27 hectare site. They're sitting within almost what you'd say inner Melbourne nowadays. I mean, there's substantial land holdings that provide enormous opportunities for other uses to be added into it over and above retail. And we're seeing that across the board. I mean, you drive down Springvale Road past the Glen and there's 3 residential towers that are being built above the centre. You go out past Eastland and there's a hotel complex. You drive past Chadstone and there's office towers and other things in it. It goes to, I suppose, the function of these land holdings, and where they're always seen as probably sort of a drive to suburban type mall, they have evolved into essentially mini CBDs and multi-purpose. And that drives, I suppose, that productivity as well, because the usages that you're getting and the visitations you're getting are more consistent over the period of the week, rather than being focused at one part of the day. So they're all the things that you start to think about when you're looking at asset values, and where will value be retained, and where are you more vulnerable moving forward as some of these structural changes take place through the market.
Right. Thank you very much. Do you think are there opportunities for retailers and landlords to collaborate and innovate and transform the industry without undue duress, if I may say?
Oh, the tenant landlord relationship has never been greater, really. I mean, the need, and Peter can talk to this probably better than I can, the need to be able to collaborate and to meet the needs of both parties. And I mean, Peter touched on it before. I mean, all this discussion around sort of the restructuring of rental arrangements to just being a percentage of sales is all a bit of hot air from some more dominant retailers around the country. I mean, kind of undermines that relationship, if you like, because the landlord has a function in that relationship, but doesn't control all of it. And look, when I look at and think about some of the more successful success stories of that, I mean, and it goes to that experimental type offering that we're talking about, is that we're seeing through all these centres, a lot of these retailers are getting larger format stores. You walk through Melbourne Central, and what were once a run of say 40 shops has become 20 shops because they've merged stores and made them more experimental. And you can walk into these and it's the experience, and it's creating that connectivity. It's a key collaboration between the landlord to provide the opportunity and the retailer and the needs of them.
Yeah, I'll just jump in there. Look, I agree. This year, it's probably fair enough to say it's not the high point of the tenant versus landlord relationship has been 2020, given COVID and the rental renegotiations that have had to occur. It's been a necessary discussion. And I think moving forward, there needs to be some more legacy cultural changes on both the landlord side and the tenant side. And fundamentally, the key for success in the future, particularly with some structural changes going on, is more use of technology across the entire trade area, more data sharing between the tenant and the landlord to really optimise location selection and optimise sales and traffic performance, and then really trying to get that omni-channel connection going between the tenant and the landlord and the consumer. I mean, fundamentally, a lot of the tenants have great technology at a store level, and really can optimize their trading performance and their sales performance, but we can provide the technology at the curb level going into the centre and try and connect those two customers together to really be able to speak to the customer from that whole shopping journey. So I think that's that's part of the future.
Thank you very much. Let me ask Richard. There's a question coming in. Richard, the question is about planning schemes and planning restrictions. So is it preferable to have a less diluted retail offering through the restricted planning scheme we currently have, as opposed to the potential of overdevelopment?
Well, look, I think if you look at it from a business model point of view and what will, ensure the survival and growth of retail, flexibility will be absolutely necessary, going forward. I can see, in the not too distant future where most shopping centres go from, what is primarily, a department store, supermarket and a string of shops into, like Stuart said, you've got a hotel there, you've got co-working. I mean, as all the city workers get pushed, to work from home. I mean, being able to drive into a shopping centre, you've got a car park, you've probably got some nice air-conditioned space, brings them in on the sort of Monday to Wednesday. These sort of trends are all ahead of us, and the planning controls just seem obvious to support, those types of range of uses. In terms of heights and densities and, traffic management and all of those types of things, yes, I think at a local neighbourhood level, they all are very important and all need to be managed. But anything that is too restrictive and just limits purely to retail, I think will end up strangling a lot of those centres, and unfortunately, they won't be able to keep pace.
Yeah, I think the other thing there, Rich, is it's about protecting that existing underlying investment as well. We're not undermining those existing ownerships as well, because we're asking these owners to reinvest in their centres and continually evolve them. And the planning regime is key in that to protect that level of investment as well.
Yep, absolutely.
Richard, another question for you. Do you think that given what has happened during the COVID-19 and the challenges that were posed, do you think landlord and retailers would need to consider how to adapt their strategies to shift the focus from driving increased dwell time to driving greater spend velocity? and consumer advocacy of safety experience?
Yeah, I think Peter sort of touched on this before with the use of technology.
Yep.
That is going to be paramount to, to increasing those dwell times and getting people to open their wallets once they walk in. I mean, my view is that, going and doing the physical shopping is a much superior experience to purchasing online. I don't know, I've been purchasing a lot of stuff online, as has everybody else in my family for the last 6 months. Well, I can tell you, a million things have gone wrong. What happened? We had a table tennis table turn up, for one of the boys for his birthday. It was dented and, I had to return it. Stuff's turned up in the wrong size and had to be returned. With my wife's birthday this week, and I ordered a book for her online, and, her birthday went 2 days ago. We're now on Friday. I still haven't got the present. I'm looking like a fool, So, this is not going to work permanently.
That's a pretty common excuse at the moment, Rich. Can I do it?
Yeah. That's it. I'm going to be blaming COVID for a lot of things that go wrong. But, the physical in-store service, that offers a hell of a lot more. I know what I'm going to get. I can inspect it. Yeah, some stuff's going to change permanently. Retailers and landlords can work together to enhance that. And you know what? They've got to work together because more than any other segment in the real estate market, their financial fortunes are interlinked. So if those retailers aren't making money, they can't afford to pay rent. And that's how the whole retail model works. Whereas the landlord for Ernst & Young's building, they don't care whether Ernst & Young are making money or losing money, really. As long as we pay the rent at the end of the day, their fortunes aren't linked to us growing or, in terms of profitability year on year, maybe in footprint, but, a little less indirectly. Retailers, on the other hand, absolutely are. So be clear, there's a lot of, difficulty in terms of re-crunching where the new levels are, as a result of COVID, but they need each other. They need each other badly, and they've got to work together to get people in and to grow, and it's very much part of our future, despite the restabilizing and maybe re-leveling that's going on right now.
Yep.
Agreed.
May I ask you this one, that what would be the next decade of experiential retail look like? There's a question also which is coming from participant who is suggesting that what other non-traditional offers could retail or the shopping center add to their existing offering? Do you think that the experiential retail will evolve?
Well, Pete's probably seen the best trends from what he's seeing in the US and others. I mean,
yeah. I always think hope no one takes this the wrong way on the call, but America's sort of a lead indicator of new concepts, particularly with Silicon Valley there, and there's a lot of new concepts which, what they call clicks to bricks. So these are pure online retailers that got to a certain level, then realize that to really maximize their sales, they go online first and then they go physical. And so I think there is a huge amount across different categories of online retailers that will go to physical stores to branch out. There is new concepts around entertainment and leisure that aren't in Australia at this point in time. There is purely experiential from virtual reality sort of type concepts. I don't think we've gone anywhere near far enough on food and beverage. It's the new social destination. In the US, we doubled the percentage in the 10 years or so I was there. We doubled the percentage of GLA of food and beverage from low single digits to high teens. So the concepts that we've spoken about on this call in terms of experiential, they're the concepts that are the future of physical retail in the larger shopping centres. But there'll be changes within the concepts themselves. There'll be innovations within the concepts themselves. And that whole mid-market fashion product selling only retail will diminish in the percentage of GLA. In terms of whole brand new concepts coming in, I think it's more aligned with what we have been saying on forum, which is more about densification and diversification of income streams to mixed use coming in. Stuart and Richard, mentioned the Glen, which is one of ours, with the 3 residential buildings, Chadstone with hotel and commercial. We've got some DAs in place at the moment. That is really where the major differential from a consumer's point of view we'll see coming into these centres. They become mini CBDs.
Yeah, and we did touch on this before. Really, the focus probably, at least for the next 5 years, is going to be about repurposing some of these spaces as we see a bit of a downsize in discount department stores and department stores. And rather than having to add new space, it's going to be a challenge to be repurposing what some of those spaces are. And you only need to go through some of the centres on your own leisure travels, and through Bangkok a couple of years ago, and you walk through the Paragon Centre in Bangkok, and they've got Sea Life downstairs, they've got a Maserati car dealership on level 2, that's all sorts of things. It's what role do these, I suppose, well-located land holdings serve going forward?
Yeah. The interesting one for us is also we're watching closely the impacts on CBDs. So this whole work from home decentralisation of CBDs, and obviously that has positives and negatives. But fundamentally, for regional centres that are connected via transport, what are the additional opportunities that are non-retail that can be connected to those centres?
Yeah.
Peter, how has COVID-19 affected future decision on capital expenditure on retail?
Well, retail, where we're focused on at the moment, and we've hit some points on this today, really, really important for us. It's a symbiotic relationship. Retailers have to be profitable. They're our customer. So fundamentally, we've provided a lot of capital sort of to retailers to make sure that they're profitable coming out of this, and as a trade-off, that got extensions of leases. What we've been focused on, and what I think a lot of landlords are focused on, is look through the cycle. Where are the development opportunities? Let's invest time, effort, and money into getting development approvals that are more focused on, again, on the mixed use rather than the retail, and making sure that we have the right plan in play. But there's going to be a lot of so our development program, so to speak, hasn't necessarily changed. We believe we're absolutely on the right strategy, but fundamentally it's probably elongated. They'll be de-risked a hell of a lot more in terms of the major capital expenditure. So based on pre-letting, etc., before those type of projects commence. And then on the capital side itself, from operational capital, from our point of view, I think I can guess what the outcome's going to be, but the banks will be less conciliatory than they have been this year. And so as a result, I think the substitute will be more landlord capital into the system to support retailers to grow within the business. So I think that's definitely a component. And then we spoke about some of the local neighbourhood centres or some other centres. So I think there'll be more capital going into renovations of centres to make sure that they're more contemporary, which basically may not lead to expansion. It's just more capital put into the system. That's how we see it.
Thank you very much, Peter. Last question. We are running out of time. We are almost at 1 o'clock. What do you think is the future of brick and mortar retail going forward? Do you think that there is still a growth phase that you would observe much beyond what we have observed in the last couple of decades?
Who's that one going to, Push?
I'm starting with Peter. Maybe I'll.
Look, I think we're going to enter an interesting phase over at least the next couple of years, and I suppose that the budget sort of highlighted that announcement. I mean, our population growth is going to be quite muted over the next couple of years, and like it or lump it, Australia hasn't necessarily been an innovation-led story. It's been a population growth-led story over its journey, and so that's going to put not put the brakes on things. It's just going to put a bit of a pause, I think, on new development. But in terms of going, when you see beyond that period, Melbourne will see the return of population growth, and that requires a need for community hubs and services, and retail forms a crucial part of that. And we're also going to continue to see the densification around sort of existing social infrastructure, and we're seeing that's not going to go away in the longer term. I feel that what we're going through is a bit of more of a short-term blip. So, I mean, retail and what it offers will continue to evolve, but bricks and mortar is not going away. It serves a crucial function in the social fabric of any population.
Peter?
Look, from my point of view, I think the stronger centres will get stronger. And I think typically if you have a strong master plan that brings in mixed use and strong centres that are well connected, they will get stronger. It doesn't necessarily mean they're going to have major expansions of retail. It's repurposing of the space. I think there's still a whole, you can talk motherhood, but there's still some gaps within the Australian landscape for quality retail offer. There's not many. It's mainly built out in the sort of major regional space or repurposing of that space. And I think there's growth. That's one thing that planning policy is hard to prevent, to be honest, unfortunately. But I think there is growth in the neighbourhood shopping centres to be populated around residential subdivisions and all those type of spaces. That's how I see it. But I don't think you'll see too many significant retail developments commence in the next couple of years. More repurposing of existing space in retail.
Thank you very much, Richard.
Yeah. From my point, Push, we are going to see vacancies in retail stores. That is going to be something that's going to be prevalent for the next couple of years. And I think that's unfortunately going to be the case until we can get business conditions which are going to be strong enough where people are going to take the risk on starting to grow new businesses and open new businesses. So they're going to look for economic conditions. If that doesn't happen, what we'll find is that a lot of retail will actually start to get repurposed. It'll happen at the local strip, place where a shop will go, but maybe a gym will open in its place or something like that, or it'll happen in a shopping centre. Like Peter said, with one of the department stores, might end up going, and all of a sudden co-working space might get opened up there, and people are starting to fill the places up on a Monday and Tuesday, and the footfall's back. So it will be, it will be on the nose for a little while to come, and there are certainly some challenges ahead. We know that, but it will be part of our landscape going forward, and I'm sure it'll come back stronger. Both retail tenants and landlords need each other, so they'll be at the table working out what works.
Thank you very much. I think it has been incredible 1 hour where a lot of issues related to retail got discussed. So I know that it's a very complicated issue and we had less time. Thank you everyone who participated in today's discussion and sent their questions. Some of the questions we could not take. My apologies for that, given the time constraints. And thanks Peter, Stuart and Richard for your valuable time today. Thank you very much.